Okay, we are watching Disney, one of the many earnings stories out today. Shares are under some pressure. They're down about 3%. This is a massive company, and it's a company that obviously has to keep tabs on consumer demand for its theme parks and cruises, but also on the shifting winds in media as the legacy business continues to feel pressure. But Disney pulling the trigger on some interesting deals tied to its streaming future. Naveen Sarma is a media and entertainment analyst and a managing director at S&P Global Ratings, joins us now to talk a little bit more about the business of Disney. Naveen, thanks for being with us. Let's just start with this transition the company has been going through. When you have so many businesses, there's always a need to prioritize where you're going. But what was the big takeaway on Disney, in your opinion, in terms of how they're positioning the business for the long run here?
Sure, and you actually point this out, which is given the size and the scale of this company, they can do things that a lot of their peers can't do. As we've seen some of their peers, can contemplate spinning off some of the linear TV businesses. We're watching Disney make investments both, with the NFL as well as WWE. They're bringing 2 cruise ships online later on this year, this calendar year. So, given where Disney is and its scale, they're able to do these things and try to position the company for growth going forward.
All right, so maybe you can walk us through these announcements they had. So the business deal with the NFL, where basically the NFL makes a deal with ESPN, and then also this deal for WWE, which I guess, how does that fit into the streaming future of the company?
Right. So let's look at WWE first.
Sure.
The NFL is a much bigger and more interesting transaction. So WWE, was on, at least this particular package was on NBC Peacock, and so moving it over to Disney. Disney's now launching ESPN standalone. They'll be able to offer this as available on their streaming service. So what they're trying to do clearly is have more value, show consumers that there's value in subscribing to ESPN standalone streaming service. The WWE certainly does that. And one of the questions it does raise is they also have the agreement with UFC, which ends at the end of this year. Does this replace that agreement, or if they're able to add some component of the UFC in the future, they're going to have both the WWE as well as UFC for consumers. On the NFL side, it's a really interesting transaction. Probably one that other media companies are really unable to do, and it shows really the importance and the scale of ESPN to the sports ecosystem. The fact that the NFL was willing to do this transaction with ESPN.
And so as they make those moves to figure out how their new ESPN streaming service can perform and be competitive with traditional media, what's happening with the rest of the business? I guess we've already seen them make massive commitments to theme parks over the long term. How do they balance that, and how should investors think about that part of the equation?
Yes, so Disney, more than any other media company, thinks long term. Right, they're playing the long game here, and so the investments that they've announced, the capex spending that they've announced for the experiences business, the theme parks, $60 billion over 10 years. That's going to show up in new rides. They're building, with a partner, the new theme park in the Middle East. You've got the new, cruise lines coming on. Look, Disney spends money for the future. The investments that they're making in ESPN, and look, they talked about this on the call, the linear TV business is clearly under a lot of pressure, and so when they make investments in things like ESPN streaming, or they put Hulu and Disney Plus together, that's looking at the longer term ecosystem, and so they'll make investments clearly where it makes sense in streaming or in experiences, and they'll try to manage the costs on the linear television side.
So how should people think about the investment story of Disney? Because for a long period of time, it felt like they could do little wrong. But in terms of sort of the large media plays that are out there, there's a lot changing. Obviously, you've got the deal for Paramount right now, so maybe it's easier to navigate all these changes behind closed doors. Who knows? But what's going to be the thesis that Disney drives home on what makes them stand out in a market, quite frankly, where people can get growth all over the place. They're excited about AI this and AI that.
Right. Right, and so remember, I'm a credit analyst, so I'm not looking at the equity, I'm looking at the long-term credit quality of this company. And Disney is an A-rated company. There's not a lot of media companies. Netflix is an A, but really, if you look at the rest of the peers, whether it's Paramount or Warner Brothers, those companies are suffering or having a difficult time navigating this transition from a legacy linear environment to more of a digital environment. Disney's able to do that and also maintain a pristine balance sheet, or a much better, stronger balance sheet than its peers. So, from our standpoint, when we look at the ability for this company to generate cash flow, to make investments in its business going forward, it's what gets us comfortable with Disney as an A-rated credit.